Welcome to the deep dive. Today, our mission is pretty clear. We're digging into the Q3 2025 results for Brisa Bridgestone, Sabancı Elastics, and AIV Ticarete. We'll just call them Brisa. And we're doing this specifically for you, the individual investor, trying to pull out what really matters. So if you find this helpful as we go, please do take a second to like, subscribe, maybe share this deep dive. Okay, let's start with the basics. Who is Brisa?
Right. Well, Brisa is a major player, a real heavyweight in Turkish manufacturing. They've been making tires elastics since way back in 1974. They're headquartered in Istanbul, Üsküdar specifically, but the big production hubs are in Izmit and Aksaray. Think large-scale tire production.
And the ownership structure is key here, isn't it?
Absolutely. It's essentially a joint venture. HO Sabancı Holding and the global Bridgestone Corporation each hold 43.63%. So equal control between those two giants.
Okay, and they're not just sticking to tires anymore, are they? I saw something about mobility solutions.
That's right. A significant strategic move, actually. They acquired an 88.89% stake in Arvento Mobile Systemler A. That pushes them squarely into the mobility and fleet tracking space. Diversification.
And that growth seems reflected in their staffing. It looked like quite a jump in fixed-term employees.
Yeah, that was noticeable. They have about 3,350 permanent staff, but the fixed-term headcount went from around 160 at the end of 2024 to over 600 by September 2025.
Wow, okay. That definitely suggests they're gearing up for something.
It certainly points towards expansion or maybe specific project needs. Now, looking at who's steering the ship, the board of directors has 11 members.
And what about gender representation on the board?
There are 2 women on the board, so that works out to about 18.2% representation.
Okay. And executive pay. That's always something investors look at.
It is. The total benefits provided to senior management for the first 9 months of 2025 came in at 250.5 million Turkish lira. That's up from about 224.2 million in the same period in 2024, so an increase there.
All right, let's shift gears to the financials themselves. And before we even touch a number, we need to talk about the elephant in the room, hyperinflation accounting.
Yes. Absolutely crucial context. Look, these aren't your standard financials. They're prepared using TMS 29, the standard for hyperinflationary economies. The reason? Turkey's cumulative inflation over the past 3 years has topped 222%. So every lira figure we mention has been adjusted to reflect currency purchasing power as of September 30th, 2025. It's vital to remember that.
Got it. So with that hyperinflation lens firmly in place, how did the top line look for the first 9 months of 2025 compared to 24?
Well, there was a decrease. Revenue, or Hasılat, came down to 29.27 billion TL from almost 32 billion TL the previous year.
Okay, and that naturally flowed down, I assume, gross profit.
It did. Gross profit fell from 7.38 billion TL to 5.97 billion TL. And operating profit, İsas Faaliyet Karun, also saw a slight dip, landing at 1.81 billion TL compared to 2.05 billion TL.
So pressure on the operational side, but the really dramatic shift seems to be at the bottom line.
Yeah. That's the headline, really. Brisa went from reporting a net period profit of 677.3 million TL in the first 9 months of 2024 to reporting a net period loss, dönem zararı, of 918.4 million TL in the same period of 2025.
Wow, that's a huge swing, almost a 1.6 billion lira turnaround in the wrong direction. Yeah. What drove that loss?
The main culprit was finance expenses. They ballooned to 5.1 billion TL. In this kind of high inflation, high interest rate environment, servicing debt becomes incredibly expensive.
Makes sense. Was there anything cushioning that blow?
There was, partially. They recorded 1.55 billion TL in net monetary position gains. Now, this is a feature of hyperinflation accounting. Essentially, it reflects the gain the company makes by holding monetary liabilities like debt while the currency depreciates rapidly. You're paying back debt with money that's worth less, which creates a sort of gain on paper.
Okay, interesting. But speaking of debt, the actual debt level itself, how does that look?
Sure. That's definitely a point of concern for investors. Net financial debt increased quite significantly. It went from 4.23 billion TL at the end of 2024 up to 6.4 billion TL by September 2025.
And with a net loss and rising debt, I imagine total equity took a hit.
It did, yeah. As Connectler, or total equity, decreased from 24.6 billion TL down to 22.8 billion TL. That net loss is the primary driver there.
So rising debt, falling equity, it sounds worrying. But what about cash flow? Are they still generating cash from operations?
Yes, and this is a really important counterpoint. Despite the net loss on paper due to financing costs and inflation adjustments, their operating cash flow remained positive and actually quite robust at 3.03 billion TL for the period.
So the core business is still throwing off cash.
Exactly. And what's more, they're heavily investing that cash back into the business. Ongoing investments, yapılmakta olan yatırımlar, hit 2.67 billion TL.
Hang on. They just posted a nearly billion lira loss. Debt is climbing, but they're still pouring billions into investments.
Yeah.
How does that add up? How are they funding that?
Well, this is the really interesting strategic piece. These aren't just regular investments funded purely from operations or more debt. They are heavily supported by government investment incentive certificates. They have substantial certificates for both the İzmit and Aksaray plants. These provide significant future tax advantages. We're talking estimated tax benefits around 3 billion TL down the line.
I see. So they're accepting short-term pain, like the net loss, potentially higher debt for now, to lock in government-subsidized growth and future tax breaks.
That seems to be the strategy, yes. It's a long-term play, leveraging government incentives to build capacity and efficiency, even while navigating a very tough, immediate economic climate.
Okay, so let's try to synthesize this.
Yeah.
On one hand, Brisa is facing real headwinds. A significant net loss driven largely by financing costs in a hyperinflationary setting, plus rising net debt. That's the tough part.
Right.
But on the other hand, their core operations are still generating strong cash flow, and they're making massive government-incentivized investments aimed squarely at future growth and efficiency. Quite a dichotomy.
It really is. And I think that leads to the critical question for anyone looking at Brisa as an investment right now.
Go on.
Given this harsh reality of the net loss, amplified by hyperinflation accounting, how do you, as an investor, weigh that immediate financial strain against this very aggressive, clearly long-term, incentive-backed investment strategy? Where do you place your emphasis?
That's definitely the key tension here, isn't it? Something for everyone to consider carefully. Well, that brings us to the end of this deep dive. Hopefully this breakdown helps you make sense of Brisa's complex situation. Thank you for joining us. And once more, if you found value here, please like, subscribe, and share. We'll catch you on the next one.